Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. What I'm going to talk about is why I think interest rates are going to go up over the next 5, 10, 15 years, however long the expansion phase of real estate lasts. So the real estate has 4 cycles. I'll go over that first. And what I propose is that interest rates is going to go up. And the reason I think it's going to go up is because based off of history, interest rates have gone up under expansionary phases of real estate. Why? Because expansionary phases of real estate are inflationary. Inflation puts interest rates in a real negative rate scenario. And when they're in real negative rates, people will sell their bonds. And interest rates will naturally, in a free market, go up. QE, or quantitative easing, the sole purpose of that is to buy those bonds to create an artificial demand for bonds to suppress rates lower. So what they're doing is they're buying bonds and pushing the rates down. If the market naturally wants to increase interest rates, if you put this in a real negative interest rate environment, no one's going to buy bonds. It's suicide at that point, because all you're going to do is lose purchasing power. So then what's going to happen is you're going to get continued an increase and a continued increase in more people selling bonds. Eventually, if you're trying to hold it flat interest rates, you're going to have an increasing amount of bonds that you'll have to continually purchase. So eventually you'll go from buying 10% of them to 25% of them to 50% to 75% to 100%, which means that you're going to have to basically buy all of the bonds that come into existence to hold rates lower. And that pressure is going to continually build over time, where people aren't going to buy them at all. And then at some point, you're going to be left with no buyers except for the central bank buying it all. So I'm going to go over what the expansion phase is and over history and the real interest rate, and give you guys a little bit better idea. So I've got the Fred. This is the housing starts, and the housing starts it's basically residential real estate. The black line here is the average. And what we see here are the housing starts, which is how many new homes are being built over time. And this is the real estate cycle. It's a recession going down, a recovery phase going up, and then we go above this black line, it goes into a large expansionary phase of real estate. The higher we go on this y-axis here, the higher we go up, the more inflationary it is. It means that we've got more new loans against more new homes, which means that the money supply is increasing. And I can show you what that looks like on this real interest rate. The black line is interest rates. The red line here is inflation. And the difference between these two lines is the blue line, which we consider this to be the real interest rate. You can have a positive real interest rate and you can have a negative real interest rate. And what you're going to see is that the inflation is lagged behind the housing starts by a year or 2 or 3, somewhere in that range. So what happens is you start going into an expansion phase. We did this, let's say 1971 or so. We go into this huge expansion phase of real estate. I am claiming that this is going to be inflationary, but it is lagged by a couple of years. We went in it in 71. 71's right here. It's lagged a couple of years, and then you can see the inflation rate in the red line start to move up. Then you could see this pulled on back. Now we hit a bottom of 75. Keep in mind, this is delayed a few years. So we come back, we hit the bottom here in 77, delayed 2 years, and then we go back up because we have the floodgates open again for an inflationary period. And then eventually in 1980, the floodgate of inflation closed around that 1980 area, and then the inflation started to come back down. During that time frame, we had what's called real negative rates. That's what this red area under the curve is. These are all real negative rates. This is what gold likes, and this is when interest rates start to go up. Interest rates is the black line, and you can see that coming on up and following basically the inflation just lagged a little bit, but they're very highly correlated. And eventually the inflation rate petered out and went down because of demographics in the real estate market going into a bust That's what the 1980 and this yellow area under the curve is over here. And the generator of that inflation went away, so the inflation rate came down. And then interest rates followed with a little bit of a lag, the inflation region. So inflation ceased to exist, interest rates continued to go down over time. And we had positive rates all the way from 82 to about 2001, 2002. And that entire area, as this was basically the time to be in stocks, was in the early 80s all the way to 2001, because you had a declining interest rate environment during that time frame almost the entire way, which basically revalued stocks higher. Now, what we're going into recently, this was the last boom here from 2000 to 2008, which is about this spot here. If you look at 2000, we had a little bit of negative rates coming during that time frame. Those little negative rates, this pushed gold higher from like 2000-ish as it was dropping down all the way to 2004 is when the gold miners really did very well. It doesn't like rates going up, so gold paused and miners did not do very well, but gold continued to do very well. And gold really started to take off when rates went negative from 2009-ish all the way to 2011. And right now we're in conditions where we have very large negative rates. Negative rates puts pressure on interest rates to go up. It doesn't mean that they'll necessarily go up, but if the pressure gets big enough, I think that they're not going to be able to hold it down because they're going to have to buy too many bonds for basically a very long time period. And the reason I think that is that we've got this big, large yellow area under the curve here in the 2008-9 timeframe, all the way till I'd say 2018, 2019, where we didn't build enough homes. That's what this yellow area under the curve is. And usually when you have a yellow area under the curve, you have a close to match red area above the curve, unless there's a little bit larger demographic that went through like this area over here, so you'll have more area under the curve for the bigger demographic. What we have coming up today is we're in an underbuilt scenario because we screwed up the housing market back in the mid-2000s. We overbuilt, and we had all the foreclosures, which led to an underbuilt scenario in the 2010s. This underbuilt scenario is quite massive. And we also have a larger demographic coming called the millennials in home buying years. So right now it says America is short more than 5 million homes, and builders can't make up the difference. And that was September 14th, 2021. Some 12.3 million American households were formed from January 2012 to June 2021. But just 7 million new single-family homes were built during that time. Single-family home construction is running at the slowest pace since 1995. Here's 95 down here, and that was probably comparing it to somewhere in this range, but we went way below it. Pulte Group is just, it doesn't matter. The U.S. is short 5.24 million homes, an increase of 1.4 million from the 2019 gap of 3.84 million, according to the new research from Realtor. So we continue to pile on more and more homes that we're short. It means that we need to build 5.24 million new homes above the average of this line, which means we could potentially go into a massive bull market in real estate because of this shortage. And that's why inventory is so low. And then I've got on the bottom here, QE, and to address, so they're doing QE and you can see how much they're doing. Federal Reserve is this line down here. They've been doing QE at about 4.5, 5 trillion. And they've ramped it up here recently because no one's buying the bonds. And in 2019, when interest rates started to go up, they had to increase their purchases, which is going to put more inflationary pressures in the system because the floodgate of what I consider to be the floodgate or the gate that keeps inflation shut is the real estate market. But that gate's going to go, it's going to open, and it's going to be a very big opening based off of how many homes we have to build. for the shortages that we have in the real estate market. And if you notice, the rates go negative here in big expansionary phases of real estate. We didn't have a huge expansionary phase here because it didn't go as high, but it lasted somewhat long. So this is a little bit bigger inflationary period, and you're probably going to see it lag a little bit. But this is the inflationary period here. It went up, and then we had this. We went pretty high here, which means your inflation rate, which is the red line, went up quite a bit and really started to take off. And that's where this real negative rate came in. And interest rates wanted to go up. You could see it in 2009, and then they brought it right back down. What I think is going to happen here is it depends on how big of an expansionary phase we get and how many new homes we can build will determine how much inflation and how big that inflation rate's going to be. What I am saying is I don't necessarily know how many homes we're going to build, but the conditions are there where we could really build as much as we want for a very long time because of the 5 million homes that we are short in the market. And for 5 million homes, if the average is 1.4 million, let's say it's 1.5 million, and you want to build 500,000 over or 600,000, you're at the 2.1 million era, which is about the peak up here. And you could hold that area for a very long time because if we're short 5 million homes, that means we got to build, 2 million, 2.1 million for probably almost a decade. And that means 10 years of being in an expansionary phase of building a very large amount of homes. And that means new loans against new homes, which is going to be an inflationary period. And we've seen that inflation in history every single time kick up the inflation rate. And that inflation rate is very close to how many new homes you build. We had a big inflation rate here, over 10% and 15% here with this area in here. And the money velocity also kicks up a little bit during those time frames. When people are buying homes, they have kids, and when they have kids, they spend more money. That's just the phase that humans go through the demographics. And what we're seeing here is, in order for them to continually hold down those rates, they're going to have to continually increase how much bonds they're going to be buying in QE to hold rates down. What I am proposing here is that they're going to see a pressure that they haven't seen since the 70s. And it's going to be even bigger than that and longer than that. And I don't know if they can print the amount of money to buy all of the bonds and have inflation go up in the 10-15% range. I don't know if they can piece this and hold it all together. That's where my head's at because of the underbuilt scenario in the real estate market. So what I'm proposing is that we need to watch the housing starts. If they continually move higher and upward, what that's going to tell us is that inflation will be coming a year or two lag behind it. And if we go and build enough homes, this money's going to get loaned into the system. It's going to start sloshing all around, and it's going to raise prices. They look at lagging indicators like the consumer price index, but that is going to be lagged behind it. And we're already seeing the producer price index, PPI, starting to kick up, which will eventually lead to higher prices of goods and services. And I think what's going to happen is we've got that huge expansionary phase. We've got all of the market conditions in place for home prices to go rocketing higher. New homes are going to be built. Those new homes are going to be inflationary. And depending on how many they can build, the rate of it will determine the inflation rate. If the conditions are in place, I don't see why we wouldn't build these homes. Structurally, we're going to have to build them. Otherwise, you're going to go to prices that are ridiculous levels. And the only way that you can balance this entire market is to get homes to be in ridiculously priced areas. They got to go way higher, because what you're doing is you have to bid out all these people who want to buy homes. They have to all the market's going to have to balance each other out. And if you don't have much supply and you've got a bunch of demand, if it's a 10-to-1 demand, 10 buyers to every single home that's available, that means that 9 people have to get priced out of every single house. That means that only 10% of the people will get it. That means that the top 10% of bidders get the home and the bottom 90% don't in a lot of these cities that are very short in inventory. If they all decide to go build homes, then guess what happens? You get a bunch of homes and it's expansionary. And that's what happened in the 70s, and I don't see why it wouldn't happen today. And what happens is that inflation rate is going to put pressure of real negative rates. Real negative rates is going to pressure interest rates higher because no one's going to buy bonds. And that's why I think interest rates are going to go up. They're going to go up because no one's going to buy bonds. And your inflation rate is going to continually go up. If it's continually going up, you get larger and larger real negative rates, and then you have an inflation problem. Then you start playing with the psychology of people. And if there's nothing there to slow it down, it's just going to continually get worse and worse. You're going to get a velocity kick up of money, and then you're going to have inflation at rates that you probably don't want. And there's no way to stop it. And they're going to have to raise rates. That's the way that I view it. But you know what? I could be wrong. Maybe they hold rates down and we have a hyperinflation and your dollar goes to nothing. I mean, that's a scenario. Because if they allow rates to go up, they can't afford the debt and they're going to print it all anyway. So either way, it's a default. You're defaulting with the dollar going down in value. Because of the underlying structural conditions in the real estate market, which drives inflation up. If you look at Japan had the opposite effect. They had a shrinking demographic, and their real estate market continually declined for a very long period of time. And if you look at their interest rates match their real estate market to the T. If you look at the M2 money supply per capita multiplied by velocity, you basically are charting your real estate market if you do that calculation. We did the calculation. I say we, someone at work did it. And he graphed it and then overlaid the median home price over it, and it's the same exact graph, which means that the housing market is the gateway for inflation. It's not even debatable. I mean, you got the data, it's all right there, it overlays perfectly. Every little tick mark, every little move up and down on a month-to-month basis, it's basically the same chart. So if that is the case, and you can see with the real interest rate and how they correlate with housing starts in the real estate cycle, then if we're underbuilt by this amount of homes, I don't see how we don't have an inflationary environment. If we have an inflationary environment and the pressure continually builds as we get more people going into building homes, because that's right now we have a labor shortage there, and it could hamper it a little bit. But we're just going to go into some massive inflationary period, which is going to put so much pressure on interest rates to go up, because who the heck's going to buy a bond? No one will, which means they're going to have to buy absolutely everything to hold rates down to where they're at today. And I don't know how that's going to work. I mean, they're going to be printing trillions of dollars, many trillions to hold it down, and all this money is going to be all over the system. People are going to get scared, and then the velocity kicks up, and then they've lost control. So that's my take on it. If you guys like this content, give me a thumbs up. Appreciate you guys listening. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.